Hello and welcome to Informed, a new monthly video series. Here, we look to share Fidelity's view of markets and the economy, what we're hearing from clients, and investable themes and actions for the quarter ahead. So in this first edition, we explore the outlook for 2024, laying out 4 macroeconomic scenarios for developed markets, each with their own probability weighting. Our base case is for a cyclical recession led by the consumer, depleting their pandemic-era savings, and corporates facing costly refinancing. Falling inflation will eventually lead central banks to cut interest rates, but only once the damage to growth becomes more obvious. There will be several elections across the world this year, coinciding with a renewed interest in fiscal policy to maintain budget deficits. So all of these events put together can potentially impact markets and their valuations. Based on recent conversations with some of our regional clients in Asia, they have clearly turned more optimistic. We're now seeing a majority of them positioned for a soft landing and for rate cuts this year. Views towards equities have also clearly turned more positive, with a preference to developed markets, especially towards Japan and US. In Asia, investors are selective towards India and ASEAN. The call to increase duration in fixed income portfolios is now prevalent from those expecting interest rate cuts in 2024. Fidelity's base case for a cyclical recession could result in a mildly risk-off scenario, but we believe that selective opportunities exist. We have identified 4 investment themes. The first, defensive assets with an income focus. The second, market laggards and value. The third, opportunities in Asia amidst uncertainty. And the fourth, a differentiated approach to growth. For the first theme, we like global, large-cap dividend equities and high-quality investment-grade bonds. Global large-cap dividend stocks offer consistent dividend growth, and they tend to also be more resilient in a volatile environment. Long duration and unconstrained investment-grade bond strategies that can allocate to various building blocks are likely to benefit as well. For the second theme, opportunities exist for active equity investors that do not follow the herd. Here, US equities look attractive, especially in areas that have lagged the market in 2023. Mid-cap stocks also offer good, specific opportunities. So the third theme we have identified is around Asia. We like dividend, quality equity stocks that provide income. They also tend to be more resilient. In China, we take a contrarian approach, focusing on stocks with strong fundamentals that have been overlooked. Looking to Japan, we believe there are still opportunities for disciplined investors after last year's strong rally. While acknowledging the long-term potential of the tech sector, we are also mindful of the risks from crowding into stocks that have done well in 2023. We prefer a differentiated, valuation-led approach that avoids momentum stocks to generate returns. In summary, while the outlook remains uncertain, investors should still stay invested but be selective. And I look forward to sharing more with you in the coming months.